Welcome to the Scottish Property Podcast. This is a show where we aim to educate, inspire and entertain through real life stories and interviews from people in the Scottish property community.
As always, thanks for listening and give us a follow on social media and subscribe to our YouTube channel. Remember to join us at our monthly networking events on the first Wednesday of every month. Tickets are available on our website. So without further ado, we'll just cut straight into this week's podcast. Welcome to another episode of the Scottish Property Podcast. My name's Nick Ponty, here with Steven Clark.
How you doing, Nick?
Good. It's just the two of us for this one, right? So we're going to dive into this this subject. We keep hearing week after week the headlines, what they're telling us, buy-to-let's dead.
I'm nervously smiling here because, yes, the topic of today's discussion between us is buy-to-let dead in Scotland in 2023? And you know I hate doom and gloom stuff, but it's a conversation we need to have.
Definitely, right. So you stand up in front of crowds of people, you know, delivering your courses and that, try to get people involved in property. You've also just bought a 39 unit portfolio as well. So what do you tell people, right, when you meet them at networking events? Because I was at a networking event last night, actually, SAS Pensions. Pretty much everybody that I talked to had a few buy-to-lets, but they were saying to me, no, it's just not working anymore. There's not enough in it. I don't get excited about it. There's no cash flow. So they're all looking to commercial property. But obviously, as somebody who does education, getting involved with people who are looking to enter into property, who are looking at buy-to-lets, what do you kind of say to people now about why is it still a good strategy?
We pivot, we adapt, we change. You know, interest rates are not always going to be where they are at. Rents are not going to be where they're at. Capital values are not going to be where they're always at. Everything's going to vary. We should, if we're property professionals and we know what we're doing in property, we should be able to make money in property in a downward market, an upward market, a sideways market. It shouldn't really make a difference. So you just change, you just pivot, you just adapt.
What would you say is kind of scaring you at the moment in terms of, not scaring you, but what are the main concerns? Obviously, let's just highlight to people why are people having these conversations in networking rooms now? You know, some people are just moving away from buy-to-let property. Well,
let's face it, we've not had an easy ride for the last couple of years as investors in Scotland, particularly in the residential sector. Where do we even begin? I mean, ADS going up from 3% in England, I suppose, to 6% in Scotland. Nicola Sturgeon interferes.
Rent caps.
We've done an eviction ban. We can't evict our tenants right now. We can't put the rents up. Well, we technically can. We can put them up 3% now. So yeah, we've not had an easy ride. And then it felt like this perfect storm that's just brewing. Now the interest rates just keep rocketing up. So you can understand why people are getting doom and gloom. But is it all bad news?
And before you class me again as negative Nick, right? Because I'm actually getting people coming up to me now at networking events going, negative Nick, there's negative Nick. It's caught on, by the way. So before you go down that route with me, I am actually all in buy-to-let, right? I love it as a strategy. I still love it. I don't care if the cash flow figures are only £150, £200 a month, because for me, it was always about the long term.
Mate, you and I both, we've never been in this game for property. We both started at a similar time, probably 16, 17 years ago. We're not in this industry. We're not buy-to-let investors for a quick rich. We're not going to get rich tomorrow off a buy-to-let buy. We know it's for the long-term game. So I was actually going to ask you the same question. Are you still investing?
100%, yeah. Absolutely, and I'll continue to invest and try and expand my portfolio. Obviously, I've taken a bit of a freeze at the moment because I've been building the lettings business, and you know, there's all this talk about loads of landlords selling up and exiting the market and all that. Personally, within the 200 properties that we manage, I've not seen a huge exodus. Yeah. So for me, it still works for people. I'm still getting regular inquiries from other landlords and investors across the country wanting to invest in buy-to-let property in Glasgow. Now, I would say there's an opportunity for people down in England, London, the southeast, where now with the rise in interest rates, if you hold a portfolio in London and you know your average price of 2-bed property is probably £500,000, £400,000, you know, the interest rate's going up on that kind of loan to value, possibly that's wiping you out.
Yeah, I completely agree. I think that we've probably just eliminated more amateurs, people that were maybe starting out, maybe they were doing it for the wrong reasons or looking at that cash flow and wanting that quicker gain. But you're seeing the people that we're interviewing in the podcast every month. Like, these people are all in on this strategy. It's also creating more and more opportunities. So I've said this time and time again, every time we get attack or something negative in the media on the buy-to-let sector, all of a sudden we end up seeing more and more portfolios coming for sale. Landlords going, do you know what, fuck it, I've been a landlord for 15 years, 20 years, I've got these portfolio here. The beautiful thing right now that we're seeing particularly every week in the community is that's creating bigger opportunities. If a landlord's sitting there with 10 or 20 properties, historically they could wait until a tenant moves out and then they could put the property on the market for the open rent, and they've opened up the marketplace to anyone to buy this property. Right now, we can't evict your tenants. Most of them leaving because the rents are rising so much. You can only put your rent up 3%. So right now you've got this perfect storm where we as investors that are sticking in the market can actually hoover up the opportunities from the ones that are exiting. So yeah.
There's a couple of reasons why I still think, buy-to-let property in general is still the number one asset class, right? And I don't do a huge amount of investing elsewhere. I've got a few stocks and shares. I don't do crypto or anything like that. I know there's many other things you can do with your money. I'm all in on building a business, and that's one asset that I really value a lot, is building a trading business as well. But in terms of the property stuff, I still think it's a great way to store wealth and get a steady return over a long period of time. And one of the reasons for that is leverage, obviously.
Yeah.
What other asset class can you buy a property, basically you're getting 75% from the bank. Do you get 75% when you go and buy £100,000 worth of shares?
Nope.
Given to you, do you know what I mean? So the leverage for me, and obviously that is getting more expensive and people need to be aware, higher interest rates and all the rest of it. But when you're getting, on average, if you look at the course of a property cycle, maybe, I'm just talking average figures here, say the property value was up 5%, right? You bought it for £100,000. Right, you're getting that 5% increase on
the full amount,
the full leveraged amount, not the 25% that you've put in. Do you know what I mean? So actual return, you're 5% on the property price, but really, in real terms, it's going up 4x.
No, that makes a huge amount of sense. Absolutely.
Do you know what I mean?
Yeah, so your cash flowing.
So then we go back to again, but what about interest rates? This is the main argument you get.
This is the thing. I think we've been probably spoiled for the last 10 years. We just got used to the interest rates being so low. But if we cast our minds back to when we first started, we're probably almost at the same interest rates as we started at, 5-6%.
Well, pre-2008, you're talking about it was 5-6% or something like that.
So, you know what I mean? We've just, when it dropped, it was like, oh, this is great. If we were smarter as investors, we probably should have overpaid debt and deleveraged a little bit. Going forward right now, and I'm trying to think of a positively to try and maybe add some value to the listeners rather than the doom and gloom sell up or no, I'm not going to bother getting started. We've been promoting this BRR strategy for the last few years in the Scottish Property Podcast. Lots of people are scaling up portfolios and earning their own money and leaving no money in the deals. Maybe there's just pivots. Like I was saying this to someone a couple of days ago. If you can get all money out deals, but you're leveraged up at 75%, and now with the new interest rates, they're now no longer cash flowing, or they're breaking even, or it doesn't pass a stress test. Well, don't leverage up to 75%. Leave 10 grand in it and leverage to 60% or 65%. And I hear you kind of saying, well, where are you getting that extra 10 grand to leave in each deal or whatever it may be? Well, flip a property a year. Make 30 grand, leave 10 grand in each property you've bought. You've bought 3 properties throughout the year. You flip one. The one you've flipped, the money you've left in the 3 deals, you're lower leverage. You're leveraged to the next 6% loan to value.
Great point.
Do you know what I mean? So that it's just a way of pivoting.
Great point. So look, what you've got to do is look at a long-term strategy, and this has made me think as well, right? Where do you end up in whatever it is, 20 years' time? Do you end up ideally with a smaller portfolio that's no debt, unencumbered properties? Say you were in a position right now where you've been paying down the debt over the years, right? And you've now got even 6 properties that have no debt on them. You've got no exposure to interest rates. Rents on newly let properties are going through the roof. What a great position to be in. How can that not be a good investment?
Yeah, no, I completely agree. And I try and take lessons from anyone I deal with. Like a lot of the portfolios we've been buying in Aberdeen over the last few years, I like to understand the landlord's position at the time and what did they do with their portfolio. If you bought it 20 years ago, why are you selling it to me distressed 20 years later? And we got one that came in the group a couple of days ago. I think it's a portfolio worth about 1.5, 1.6 million, but the guy's in his 70s, he's still got debt at 1.1. You're thinking, you've kept on an interest-only mortgage up to 75% loan to value. At some point, could you have deleveraged a little bit through this, period of 25, 30 years you've owned the portfolio? But most people either milk the cash flow, don't build trading businesses like you or I are doing, or they leave their job, they try and cash from the property, and then they take all the income and don't.
Well, that's the conversations that you have with people, is you're like, why do you not like buy-to-let, or why are you getting out of buy-to-let? And it is about, it's not getting me to the point that I want to be. It's too slow.
Yes.
So you don't get into, certainly not now, for cash flow, right? Which most people are wanting to, most people you speak to get involved in property, they want to basically replace their incomes, aren't they? Or get out of the rat race, or a lot of the people that you speak to.
But this is what my point was. This is more a new age strategy for the last 10 years, where people were talking about the cash flow, and each property will cash flow you £300 or £400 a month. You'll get 10 of them. That's giving you your financial freedom. You can jack your job. Yes, that's maybe not there right now. From us talking at the end of June 2023, interest rates just went up to 5%. You're looking at a buy-to-let mortgage and a limited company about 7.5%. That's expensive borrowing from what we're used to. Like we were just talking off air, off the properties I've got that are coming up for renewal in the next year or two, and they were 2.75 in the limited company up to maybe 3.1. So the cost of borrowing's doubled. But yeah, if you're buying in for cash flow, just pivot. Pivot, build up another trading business, or stay if you're staying in your job and that was additional cash flow, or source some properties. There's investors looking for deals, or it's like I said, flip.
The reason why I still love it is because I can never see this housing shortage. I mean, it sounds pretty horrible, but there is a terrible problem with housing shortage and rents going up, right? And that sounds terrible. People listen, that's why you love it, because you can milk the rent and can charge tenants to the roof. It's not really that. It was, the government have messed it up, but it's actually played into our hands to the detriment of the tenants. Well, they're trying to save the tenants, but it's gone the other way.
It's hurting them,
For me, there's a shortage of house, and that's never going to be solved in the next, our lifetimes anyway, unless they build on a massive scale. Here's a question for you. Look at the smart money, the big institutional investors. Where are they putting their money?
They're coming into buy-to-let sector, build to rents. Yeah, exactly. You raised a fantastic point there as well. And I was speaking to someone that's talking about SAS pensions just yesterday, and they had a big, massive director's loan that they put into a limited company, $600,000 to start in resi. Thought it was too slow in resi, so flipped into commercial, and they're going to use their SAS and stuff like that. I feel like buy-to-lets for the average person is achievable, and you mentioned a great example that you can leverage a bank lending. So if you're putting down 25%, $25,000 into $100,000 property, you're getting the growth on the full asset value. For my strategy is the BRRR, so I'm getting most of my money back out that property, and it's costing me very little. So if that property ended up costing me, let's just say I'll leave a few grand in the deal, and the property's worth £100,000, I'm getting the 5% increase, like you the example you used. But there's 5% increase on $100,000. But if the properties cost me $1 or $2,000 and I've made $5,000 that year, it's a phenomenal return. Exactly. Where are you getting that anywhere else?
Look at the return on investment for that, even if you're not making any money per month.
Do you think the ones that are exiting that you've spoke to then, that they're looking at it from the cash flow point of view and not actually factoring in any capital appreciation? Because I feel like people do that. My cash flows went from $350 to £80, this is not worth the hassle it's written on. But if, like you say, if you're getting an average of 5% increase a year, that's not getting factored into your costs that you're projecting.
Exactly. There strengthens the argument for the real money in buy-to-let is made through capital growth as well. Now, I know that you get this crazy stat that's thrown out, right, in property education circles, like property doubles in value every 10 years and all the rest of it, right? I'm not buying into that, because it's not going to double over the next 10 years.
Not the next 10 years.
No, you might have had that for the last 20 years, but no way can it still go up at this rate.
See, I find stats like that really fucking annoying as well, because I was giving Barry Gray, that we just had on the podcast today, an example of this. I bought and it depends on what stock you buy, it depends on what area. So there's two properties that I bought in my portfolio, and the last ones I bought in my personal name, probably about 2014-15. One was a shitty, low-level flat. I was getting all my money out of it, so I'm thinking, it's cost me nothing, keep it in the portfolio. $40,000 flat, valued up at $80,000, mortgage on it at $60,000. all money back out it, rents, and I'm getting a couple of £100 a month cash flow. Months later, I bought a 5-bed detached house for 142 grand that the tenants now moved out of. I'm going to sell that after a refurb of maybe 20, 25 grand. I'm going to sell that for probably about 350 grand. Like, that's a fucking great asset that's doubled in value in the last 10 years, whereas the flat hasn't. The flat was low quality stock. It was in a certain demographic that's not going to go up in value, whereas the house did. So when you hear stats like, yeah, property doubles in value for 10 years, like, it's just, it probably throws a false perception of it. It depends what you buy that goes up and doubles in value for 10 years.
I think that it's definitely changed my mind on areas and stuff like that. Definitely try to be a lot more selective about buying areas. And originally I used to get carried away with numbers. Yeah. So I was like, numbers in terms of how many properties do you own?
Yeah.
For me, that was a kind of gauge of success. And I was like, brilliant. Maybe one day I'll have like 100 properties or something like that. I would rather have
10
or 20 good properties in great areas that are going up in capital.
Going up in capital, giving you a decent tenant demographic. Not a lot of maintenance. Picking your stock right rather than just buying and chucking anything in it for a number to reach a goal, a target. Because it's like an arbitrary number, isn't it? If you pick, I want to achieve 20 properties, I want to achieve 40 properties. Why? What's the number behind it? Is it the number for cash flow? Is the number for you want to pay off the debt in 20 years? The number for capital appreciation over a period of time? You have to be specific on the numbers, not just the amount of properties, because it just feels a fucking pointless.
Why, like the other thing that pops up when you're talking to people is, it's just too much hassle, the government are killed it, can't be bothered dealing with tenants and all the rest of it. Like, you shouldn't be dealing with tenants anyway, right?
Yeah, and this is
coming from a letting agent.
But I've done this before in the podcast and bigged up like your business and what you do as well, because to me, I refer to people that have property as two different camps, and you'll probably hear it to me in my language. If I say a landlord, I mean a fucking amateur landlord that's bought a few properties, that self-manages, that doesn't invest in the capital, doesn't treat it like a business, that's slack on the compliance, or I say investor, and it's someone who's doing it right. And to me, why do you want to create another job for yourself? Why do you want to take on the expertise of dealing with tenants, compliance, maintenance issues? Why not hand that? That's someone's business. It takes a 10%, 12%, whatever fee you take from your rental agent, pass it to the rental agent and allow you to scale that business up even more. I shit you not, every single portfolio that I'm buying, every single one they are all self-managed. I'm trying to think if there's one that wasn't. They're pretty much self-managed. What is that telling you? They get pissed off. You get pissed off with dealing with tenants, you get pissed off with dealing with compliance, you get pissed off with dealing with maintenance. My phone will go with a maintenance issue from one of the letting agents, and it'll just be to give me an okay. Yeah, I've got an issue in one of the properties. Here's what's needing done. You're aware of it. It comes through in your statement. They're just giving you a heads up, but you're not dealing with that issue. You're just going to giving it an okay. And that, to me, that's a way having that business not take over your mind space, because it's an investment business. It shouldn't be a, if you're trying to self-manage and have another full-time job or another full-time business, you're just giving yourself more stress and headache.
There's a great guy I listen to on a podcast. His name's Tom Sloan, and he runs a podcast, and the name is The Anonymous Landlord, right? Which I absolutely love, because he talks about that. You shouldn't be dealing with all these day-to-day issues, these problems. You should be in the background, like anonymous. Nobody should have your phone number. Somebody should be taking care of all the problems. Yeah. He also talks about, right, in his latest podcast, he was talking about reinvesting in your properties, which I think is really, really important stuff. People are looking at going to cash flow. I need that £200. I need that £200 to live. You shouldn't need that £200 to live. That £200 should be going back into the properties, reinvesting, keeping the quality of stock good.
100%, keeping the quality of stock good, or paying down debt. So
paying down the debt.
So if you were in a position where you're up to 75% loan to value, and now all of a sudden the mortgage rates are through the roof, and you're feeling the pain. If you were overpaying and paying down debt rather than taking the £200 a month, overpaying it to your mortgages, and you're sitting at a 55 or 60% loan to value, you wouldn't be feeling a pinch right now. Do you know what I mean? You'd be still cash flowing positively.
So I think what we're saying here is buy to let, definitely not dead. Still a great asset class to invest in long term. Not good if you are looking at trying to leave your job and become a full-time property investor. No, that ain't going to happen. That's bad advice. If anybody's teaching you a course to say buy to let, you're going to become financially free. Not in this era of
or not at the scale you can start out with. I think buying portfolios at discount and at scale, possibly, yes. In fact, yes, I know you can. But starting out buying single buy-to-let units one at a time, you're not getting enough cash flow to leave your job for a long time. But the lessons that you're going to learn on how to build that portfolio, you're going to learn how to source. You're going to create a network and a community of people that are looking for deals that it's not going to suit you. If you want to source these onto other investors, it's going to make you some money. Or if you're carrying out renovations and you're getting good at carrying out renovations, can you flip properties? There's more income streams into the property business that maybe can allow you to quit your job if that's what you so desire. But yeah, just focus on a buy-to-let portfolio, thinking you're going to get cash flow to leave your job, that era's gone.
Let me put this out to listeners as well, like, absolutely, because there'll be people listening to this, they're just talking that up because obviously, like, he's trying to sell courses and he's trying to get landlords for his letting agent, so they're talking it up. Tell me, listeners, what else is there to invest your money in at the moment that's going to give you a better return than what I just explained there, right? So at the moment in Glasgow, and this is not even doing a buy, renovate, refinance, right? I can still make the numbers work on a decent buy-to-let, decent area. Just buying a property ready to put a tenant in, I can still get an 8% return on the cash deployed, on the cash invested, right? An 8%, right? Even at 7% interest rates, mortgage rates. On top of that, like I said, okay, people are like, but property prices are going to crash over the next year, right? Even if they go down, right? I predicted at the start of the year a 10%, not a crash. I don't describe a 10% as not a crash, a slight correction in the market. I just think possibly in certain markets over the country, you could get a bit more, maybe up to 20%. Just don't see how it can crash at the moment because of the supply and demand issues and all the rest of it. But even if we do get a 20%, right, which would be probably considered a bit of a crash, I would say at 20%. If you go back to 2019, look at where we were at 2019, look at where we came over COVID, and the prices have gone up 12, 16%
per
year on year.
Yeah.
We're just backtracking to 2019.
We're backtracking a couple of years,
Okay, arguably if you've bought right at the peak of the market, then that's going to be a problem. But again, that's where you're building your portfolio over a period of time so that everything's balancing out and you're de-risking as well. Because you bought a couple before that boom, you maybe bought one during the boom, so you're hoping that it kind of balances itself out.
What about diversification though? And I get that, and it would be good to see listeners commenting on what post we put out with that content on it to see where they think they can achieve a better return. What about pivoting on the strategy? So the buy-to-let arm is I completely agree that it should be the fundamental of a property business. It's a great asset class, but if you have some properties, rather than selling out or getting put off by the industry, why not put a few service accommodation or HMOs or try and venture into those strategies in different areas, different property types, different an HMO or an SA unit could cash flow a hell of a lot more, which might adjust your cash flow to suit what hit.
And there's people doing that, and there's people doing it successfully. Obviously, I don't like to get too blinded by the shiny penny. So I'm always looking at these strategies and thinking, right, everyone's piling at that now. How long will you get out of that before? It's funny. I think I came across, in fact, I screenshotted this yesterday, right? I came across a post from the Facebook spin network, right, in 2015 or 2016. And I actually posted a picture of my Airbnb bookings at the time on a 2-bedroom flat in Finiston, Glasgow, which originally was a buy-to-let, and I'd put it on a serviced accommodation. And I was absolutely coining it in, £130 a night or something like that. It was like 90% occupancy. And I was all excited. I posted up the screenshot of it pretty much fully booked, and I was like, this is bringing me in like all these numbers and all the rest of it.
Was this the group you used to get pissed on a Friday night?
I think I got banned out. No. So I had a few fights back then. A few haters, mate. That's where all my haters stem from.
This is how I got to know you.
This was before I was like, I changed my attitudes because I then realised the power of your network.
Absolutely.
And,
sorry, I threw the list.
So my point there is, I actually said on that post, I said, I wonder how long this is going to last. It feels like it's a shiny penny. You've got like guys like all these trainers and that charging courses for SA and stuff like that. Okay, it got a few years, by the way. I mean, we're now 8 years down the line and people are still doing it as a very successful strategy, but we've got the licensing. It's just kicked in. So let's see how this pans out,
No, definitely. I completely agree as well. But just the whole point of diversification a little bit. If you had your portfolio now and you had a couple of units as SA and they were cash flowing a lot better than a normal buy to let, it might make you stick in the industry in the sector, thinking that, okay, I've readjusted my strategy on a few of the portfolios and now it still stacks up the same. If the cash flow was your objective from the portfolio.
Yeah, it was interesting. I was at a networking event last night, and we had Maria Thompson on the podcast. Yeah. So Gordon Thompson, who's her husband, was there doing a chat. Well, the two of them were talking at it, right? Absolutely phenomenal, brilliant guys, love them. And they're all in on big developments into luxury serviced apartments. Gordon stepped up and he was talking about the Scottish government, and he was really ranting, he was really going for it. And he was like saying, I see that judicial review in Edinburgh, that's all well and good, but eventually the Scottish government are going to come in. They're going to basically say any residential house or flat that's been taken from the homeowner or rental market and converted into an Airbnb or serviced accommodation, they're basically going to do away with it and not let you do that anymore. So he was like, the way to go is commercial to SA. Because if you've taken a property from the commercial sector, there's not going to be an issue. If you've taken a property from the residential sector where it's been
away from rates that the councils can get income.
No. The whole argument for licensing is that it's taking homes out of the community. Mm-hmm. Yeah, people are profiteering.
Right.
So if you're taking a disused, I don't know, whatever it is,
flat that's empty
office building, a commercial space, then there's not really an argument for taking homes out of the community.
Mm-hmm, right, yeah.
So he's basically saying the Scottish government are going to go, they're going to go all in on this and say, no, anybody that's now renting out an Airbnb, serviced accommodation, and it used to be a residential property,
not going to get away with.
Nah.
So it's a good point. And I suppose if that was your sector, do you pivot?
You love this word, fucking pivot, don't
why
you?
not?
This is a guru word, pivot.
They're always going to attack you. They're always going to come after you. If there's a sector making money on something, they're going to come and try and penalise it, tax it. They'll jump on it. So why not just pivot? Okay, sell that one, put it back to residential. If it's just flats, make it a buy to let, and then go and buy a commercial unit and convert that to your SA unit.
Absolutely, and there's always ways and strategies, and you do need to. Definitely. Getting back to the actual buy-to-let stuff.
Yes, sorry,
the only other thing that I don't mind, rent caps, rent controls, that's fine. Bring them in, it's going to happen.
Do you think it makes the sector more professional, more regulated, more in control?
I think that you need to look at it from a professional business point of view, and you need to be doing annual rent increases. I think that's what it will do.
Yeah.
And there's no room for saying, but my tenants, they're good people, they've been with me for 6 years and the rest of it. No, you need to look at it purely from a numbers point of view now. Yeah.
So, and if we're getting forced on that route, does it make more sense as an investment strategy still?
Buy to let?
Yeah. Staying on the subject of buy to let.
Well, the good thing at the moment is you can still put the rents on for new properties, and when tenants change. So that's the kind of that's what's basically saved my portfolio at the moment from doing still quite well, from cash flowing quite good. So I've had a couple of tenants recently hand in notice. They say I've got 12 properties, right? 2 or 3 in this year have possibly come up for mortgage renewals. So it drops the cash flow down to some of them, it drops them down to 100, 150 quid or something like that. 150 quid maybe.
And a new rent increase.
But I've got another 3 that have had tenancy changeovers, and the rent's gone from £800 a month to £1,200 a month. Mm-hmm. So it all kind of balances itself out. So my portfolio is still performing all right because I can benefit from huge increases in rent in Glasgow. Again, that comes down to location quality of stock, quality of property that has enabled me to cushion those interest rate rises.
Any tenants that have given the notice to quit, to maybe going to move out of the property, go elsewhere, they've not realised what's actually happened in the rental market, gave the notice to quit and then just extended it, or they're not left because maybe they've looked at it and thought, shit, I can't get on that.
Not yet, which is brings us back to the argument of people don't seem to be struggling. They seem to be just getting on with it.
I always find that we're acutely aware of all these issues because it's what we do. It's the network we're in. And Davey Hutton touched on it earlier on as well. It's when your network's similar to you don't pay attention to what's going on there. And I always kind of feel that the general public we'll feel this in effect in a year or two's time.
Yeah.
And is that when the economy changes, the recession comes, the market crash, if it is coming, it's coming?
Well, it's all has a delayed effect.
Yeah.
Absolutely. Even the tax changes in 2015
Yes.
are still now filtering through.
Yeah, I've heard landlords, again, I'll use the word landlords, now realising what the fuck Section 24 is. Like,
Yeah.
this was brought in 2015, 16.
Yeah.
Oh no, I'm getting taxed on my income. Well, it's been coming in for years, but yeah, they weren't in that.
The only other thing that does scare me a little bit down the line is the EPC changes. A little bit unknown there. But again, I just can't see that happening the way that they're proposing. Yeah. It's all just absolute, like we were talking about earlier with Davey, government policies that they're bringing in, and then they just can't make them work.
Yeah.
So then they kick the can down the road, they adjust it, they'll tweak it, because they can't afford to take, again, they can't afford
to take the stock off the market.
Exactly, and people need homes to live in, and there's not enough, and we have fucking 50 people going for every flat in Glasgow. So they're going to need to do something there, and people just not, landlords can't afford 10 grand to do full EPC upgrades and all this.
This is what my question is to the people that are exiting the market saying it doesn't work, we're getting out. If you've got we've all got huge demand, like every property we're putting on the market is getting, like you say, 50 inquiries. So if you've got that much supply issue and the demand's still there, why are you exiting the market like that? I know there's interference from the government at the moment, but you know what I mean?
For me, it's a very, very low risk strategy. Yeah. Look at all these people who are going Jerry Alexander's course, right? To do, mention them again. Bastard got another cha-ching. They're another 10 subscribers to Jerry's fucking monthly membership. They're all getting involved with this commercial multi-let CMO, right? Which I think is a great strategy, and it's something that I'm interested in myself. I'll eventually probably do it myself with my trading business as the main tenant and all the rest of it. But that's very dependent on a thriving economy as well, because, you're renting out to little small businesses, nail technicians. Obviously the argument is that you're not, people are always going to spend money on hair and beauty and stuff like that. But it's quite reliant on the wider economy and businesses doing well. Yeah,
but it's very diversified tenants, not to go down that rabbit hole, but it'll be diversified tenants from the local elected government, the MSP, to, like you say, the nail technician, to a massage therapist, to an accountant. So yeah, it's a bit diversified, but yeah, it is heavily reliant on the economy. Yeah.
Maybe I think Jerry would probably argue that point. My point is,
I was arguing it for him.
My point is, you're always going to have a queue of people lining up to rent your buy-to-let property.
100%. Yeah,
and that's not going to change anytime soon.
That's not changing anytime soon. So surely that puts the buy-to-let sector in a strong position.
For me personally, I think it's still good. You're not going to make loads of money on it, but I think it's a good. I mean, look at what the other options, right? Stocks and shares, pretty up and down, volatile.
Where do you get cash flow from stocks and shares, except from a 4 or 5% dividends from well-established companies?
And you need cash.
And you need cash. Like you were saying, you can get a return on. If I leave $2,000 in it, what return am I getting on making a few grand a year on it? Like, it's a huge percentage return on.
Look at all the people that were excited about Bitcoin, right? 2 or 3 years ago, fucking Bitcoin was everywhere. All over your Instagram, bombarded with people.
Accounts.
Exactly, people, scammers. How many people are talking about it now? Yeah. Okay, again, it's maybe a little bit on the rise. I never dipped into it myself, so I can't speak from experience. Yeah. But there's always this thing, and it made people 100%. Bitcoin made people rich overnight and all the rest of it, and that's again why all the people are trying to pile in. But buy to let is boring. It's not sexy.
No, it's not.
But long term, it'll do you well.
Yeah, long term with the right strategy, the right approach, I think it'll always go do you well.
Yeah.
Yeah, and we touched on that on the market update last month, talking about the kind of, are we going to become a nation of renters again? And if we do, what position would you like to be in? The one that owns the housing stock, or a portion of the housing stock, or the one that doesn't?
Absolutely. Assets over liabilities.
I can't believe, mate, that this podcast has actually been a positive podcast.
Do I get rid of my negative Nick from this podcast?
Absolutely, mate. Yeah. Do you know what? Fair play.
To be fair, right, my business does hinge on buy-to-let investing.
But you're not. You could. I know you personally, Nick. You're not going to sit here and look me in the eye and tell me that fucking buy-to-let works if it doesn't.
My money is where my mouth is, right?
Yes, you're not going to.
And I'll continue to invest.
Yeah. And I'm the same. I'm turning 39 in a day's time. and I'm due to get the keys for 39 properties, putting that out there. That's the first time anyone's really heard about it. But maybe Sam's put on Instagram stories.
No, Sam's put it on every day. Like, I literally know the date and the time that it's completing because he keeps posting the screenshots, the fucking emails.
So yes, it's due to, the completion date's on my 39 properties. I am still putting my money where my mouth is. Still a great strategy. I see long-term growth in the sector. Am I diversifying? Of course. I've done an HMO. I'm involved in commercial property. So of course I'm going to diversify the portfolio. And I don't think if I was looking for income from a buy-to-let portfolio and it was my only source of income, but I preach that shit all the time about a job. Don't just have a fucking job. Have another stream of income. So it's the same thing for buy-to-lets for me. Don't just be in buy-to-lets. Have a diversified income.
And if you're listening to this and you're in London and you've got a £500,000 2-bedroom flat that you're losing £500 a month on, sell it. Bring yourself up to Glasgow. Bring yourself to Scotland. Invest in Scotland
here. From a distressed
and
landlord.
We'll keep you right. Connect with us at Scottish Property Podcast, guys. Hope you find that useful. Thanks very much for listening, and speak to you again in the next one.
Thanks a lot, guys.